how to prepare for a stock market crash before it happens. In this video, I'll share the research that's helping me make investment decisions right now. This is Andrew Stotts of A Stotts Investment Research. Let's get started. We're going to talk about how to position your portfolio for a falling U.S. stock market. We're going to go through a few topics: performance of stock market regions since 1989, time to think about protection from a fall in the U.S. stock market regions are not asset classes, important to know, performance of asset classes since 1989, and how to allocate to non-equity asset classes to reduce risk. Now, let's talk about the performance of the stock market. Let's start with regions. In this case, the biggest region of all, of course, is the whole world. All stocks in the world, that means about 9,000 stocks. And the United States accounts for about 60% of the market capitalization of world equity. Besides the U.S., there's also developed market equity that are non-U.S. companies. These companies, there's about 25 countries, the largest being Japan, then the U.K., Germany, Canada, and onwards. And then we have, finally, emerging markets. And emerging markets are 24 of them, like China, Taiwan, India, Brazil, Thailand. Now let's look at the performance of these regions. First, we start with developed markets equity. What we can see here is it went from 100 at the end of 1989 to 506 by July 2021. That's an average annual return of about 5.3%. Not very much when you think about it. Now also, note that I've rebased it to 100 so that we can compare it to the other markets. And here we can see emerging markets that went also from 100 at the end of 1989 to 595 by July 2021. That's an average annual return a little bit higher at 5.8%. Next, let's look at the world equity, which went from 100 at the end of 1989 to 1072 by July of 2021. That's a 7.8% world equity average annual return, so it's better than the others. Most importantly now, let's go to the United States. And here we can see the United States went from 100 at the end of 1989 to 2413 by July 2021. That's an average annual return of almost 11%, 10.6. And look at that chart. What do you see? Is it a bubble? Is it a boom? It's definitely a boom. We can see it just went way beyond. Right after the 2008 financial crisis, the U.S. market went skyrocketing compared to all the others. Many, many reasons for this. In fact, the world is now experiencing the longest bull run in history. The U.S. has just gone up and up and up. And this was fueled by many factors, such as ultra-low interest rates. Many countries couldn't lower their interest rates to that level. But the reasons why are not the focus of this research. The question that you might be thinking is, what can we do to protect against a fall in the U.S. stock market? So let's review the key points you learn in this section. The World Equity Index has about 9,000 stocks, and the U.S. accounts for 60+% of market cap. Developed market equity, excluding the U.S., has 25 countries, and emerging markets equity has about 24 countries. We are at the tail end of the longest bull run in history, led almost exclusively by the U.S. stock market. U.S. equity had about 11% average annual return. The world equity had 8%, emerging markets equity 6%, and developed markets equity, excluding the U.S., 5%. It's time to consider how to protect against a U.S. stock market fall. Let's go into the next topic. It's time to think about how to protect for this. So, timing the market is one option to protect against a U.S. stock market fall. One way to do that is just to not own any stocks. Some people sell their stocks and they hold cash. But the problem with this is that timing the market is extremely hard, even for professionals. Also, in order to build long-term wealth, you need to be invested in the market. Warren Buffett didn't get rich by getting in and out of the stock market. Now, another option is to own different asset classes. So what makes up an asset class? It's a group of assets that have similar characteristics. The asset class has a low correlation with other asset classes, and the asset class produces a return that does not have a similar pattern or return as other asset classes. And when added to a portfolio, the asset class can improve the portfolio's risk-adjusted return. Now, before we go any further, we need a tool. That tool is the correlation coefficient. I'm not going to show you fancy formulas. I'm just going to walk you through what it is and how we can use it. So what is it? It's a measure of the relationship between two data sets. And it shows what? The direction of the relationship, positive or negative, and the degree of strength of the relationship. Now, the correlation coefficient takes a value between 1 and -1. Now, we convert that to a percent, so it will appear in this study as 100% or negative 100%. For example, we could write a 0.7 coefficient as 70% correlated. Now, the positive relationship means moving in the same direction, and negative means moving in opposite directions. So how to interpret both this direction and strength? Well, a positive coefficient means a positive relationship. And the strength of that relationship is very high if the correlation coefficient is above 70%. 30 to 7, it's moderately positive, and really there's no relationship between 30 and -30. And then negative relationship, we can see moderately negative between -30 and -70, and then strongly negative if it's less than -70. Now let's talk about applying the correlation coefficient to investing, because it hints at future price movements. If we own two assets that were highly correlated, it would mean that when one rose, the other would also rise. But it raises this question, which is, why own both if they're both rising at the same time? And conversely, if one fell, we could expect that the other asset would also fall. So one of these assets does not provide any downside protection to the other. So ideally, we'd prefer to invest in two assets that both go up, but they would go up at different times. And when they fall, they would do so also at different times. This would provide like perfect downside protection. When one's crashing, the other one's rising. Of course, getting that is nearly impossible. But let's review the key points that we learned here. To protect against a market fall, you could hold cash, but it's hard to time the market. To build true wealth, you need decades of compounding in the market. You can't get that if you're in and out of the market. The correlation coefficient measures the direction and degree of relationship between two data sets, and greater than 70% correlation coefficient means strongly positive correlation or relationship. And between -30 and 30, no relationship, and less than -70 means strong negative relationship. So what's the bottom line? Prefer owning an asset class that goes up when the U.S. stock market goes down. That's what we would like. So now let's remind ourselves that stock market regions are not asset classes. I see this mistake all the time. Let's go back to where we started, regions. We considered 4 regions: U.S. equity, world equity, developed market equity, and emerging market equity. Now you could say that maybe world is not really a region. World is just combines U.S. with developed with emerging, but we can call it 4 separate groupings. Now these are all equity. So they're the same asset class. It's just that the stocks in each come from their respective regions. Now, members of an asset class move the same way. That's the definition of an asset class. It's that they move in the same direction. Let's consider the correlations of each of these relative to the U.S. equity or the U.S. stock market. And I'm calculating a 3-year rolling correlation against the U.S. stock market. World equity was 60-70% before, but now it's 95% correlated with the U.S. since 1995. These are almost identical. And remember, the U.S. market makes up 60% of this world equity anyway, so we know they're highly correlated. Meaning if you bought the U.S. market and you also bought the world equity market, they would probably both crash in tandem. Next, let's look at the developed markets equity, and we can see that it was as low as 30-40% correlated, but now it's about 80 to 90. So it's less than world because U.S. is not in the developed market equity ex-U.S. index. So therefore there's less correlation, but it's still pretty high, up at almost 90 right now. Finally, there's the emerging markets index, and this was about 30 to 40% correlated with the US, but has been about 70 to 80 since 1998. You could say that emerging markets are the most unlike the US equity market, but it's still about 80% correlated right now, which we know is a very high correlation. So if the US market crashes, what are we going to see? Well, the most important thing you want to understand is they're the same asset class, right? So equity won't save equity. If past trends can be used as a guide, then if the US stock market falls, the world index could fall nearly in tandem. Developed markets, excluding the US, could fall just a bit less than the world index, and the emerging market stocks would fall a little bit less than the developed markets. But since they're all the same asset class, they will fall in pretty close lockstep, meaning they don't provide much downside protection. Now, all of this study is looking at past data. It doesn't mean anything about the future, but we can try to learn from it and see if the relationships are maintained. Now, what are the key points in the bottom line? Well, since 1998, world equity has been about 95% correlated with the US. Developed market equity, excluding the US, has been about 80 to 90%, and emerging market equity has been 70 to 80%. All are the same asset class, so they don't provide much downside protection. What is the bottom line, you ask? Well, equity exposure won't help much if the US market crashes. Let's now look at the performance of asset classes since 1989. Let's consider three separate asset classes. That's bonds, gold, and commodities. So first we can see, remember that world equity went up from 100 at the end of 1989 to 1072. I showed you this chart before, and we said that was a 7.8% average annual return. Now, I'm not showing the US on this because the line would be really, really high, and I want to show you some other stuff. So just assume the US is on there, but we'll just look at that world. So I want to bring in now bonds. This is US government bonds, which went from 100 at the end of 1989 to 608 by July 2021. And what you can see from this is the average annual return was about 6%, 5.9. We've been in a massive bond market rally that's been decades, and you can see 6%. I wouldn't expect 6% going forward. I would expect something like 3, maybe 4%. Now, let's bring in gold. Gold went from 100 at the end of 1989 to 416 by July 2021. That's about a 4.6% average annual return. That's about half of what the US returned. Finally, commodities, which went from 100 at the end of 1989 to 139 by July of 2021. What does that mean? That means commodities had a return of just about 1% average annual return per year. What's the key points and the bottom line? Well, world equity produced 8% average annual return, US 11%. US government bonds were up 6% per annum, gold was up 5% per annum, and commodities were up 1% per annum. Commodities produced the little return, golds and bonds a bit more, but no asset class beat equity, especially US equity. So now let's look at the final section of this presentation. How to allocate to non-equity asset classes to reduce risk. Asset class correlation of returns. Well, we have considered the returns of the various asset classes. We saw that bonds and gold had reasonable long-term returns. Commodities didn't really have that much of a return at about 1%. Now, let's see if any of these can bring some diversification benefit through having negative or uncorrelated returns. This chart shows us that bonds went from 60% correlated with US equity to the current negative 40 to 50%, meaning it's a great diversifier. The average annual return, we said, was 5.9 for government bonds. Maximum correlation was 67. Minimum was minus 67, which we're pretty close to right now. And the average was minus 14. So what does this mean? If the US market crashes, bonds go up. Now, gold ranged between minus 30 and 26% correlation with the US market, meaning it's a good diversifier. Remember, gold only returned 4.6, which was about half of the US market return. And the average correlation was 0.9, minus 0.9, basically zero, uncorrelated. That's fantastic, because if the US crashed, we don't even know Gold's not going to be even pay any attention to that. Now, commodities are the final asset class we'll look at, and they were a good diversifier until the 2008 crisis. Now, not so much at 60% correlation. You may buy them for other things like getting ahead of the inflation story right now. Commodities can provide exposure to that. But here we can see there's a high correlation to the U.S. market. What are the key points? Bonds and gold had reasonable 5 to 6% average annual returns over the long term. Commodities only had about 1%. So we invest in them less for their return and more for their risk reduction characteristics. So let's look at those risk reduction characteristics. Bonds currently have negative 40 to 50% correlation with the U.S. market. Hence, they were great diversifiers. Remember, I'm saying were because we don't know. We think it could maintain that relationship, but we saw that that relationship has changed over time. Gold showed no clear relationship with the U.S. equity market, which made it a good diversifier, and commodities were not a good diversifier at a 60% correlation coefficient as of now. That's where it is. So what's the bottom line? To diversify U.S. equities, consider bonds first and then gold.